Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fajita, and let's get you up to speed with an hour to go in the trading day. It's the final trading week of August. We're actually looking at gains across the board today with the Dow up just around 150 points, the S&P pushing further above that 4,400 level, and the Nasdaq up about 0.6%. The moves to the upside coming ahead of what is going to be a full week of economic data on tap. When you take a look at some of the movement that we're seeing today, many of the mega caps, the movement there is mixed on a sector basis. Communication services, real estate, industrials among the outperformers today, but broad movements here to the upside. We only have healthcare and utilities, the only sectors as of right now at least trading to the downside. Akiko.
Yeah, Shauna, stocks looking to regain some ground after some of the losses we've seen in this month, but it is the final week of August, meaning we are likely in for light volume for trading. Stocks are already on track for monthly declines, but our next guest says it's perfectly normal and you shouldn't be concerned. Joining us now is Ryan Dietrich, Carson Group Chief Market Strategist. Ryan, it's good to talk to you today. You know, we tend to sort of look at more exaggerated moves this time of year because of the lighter trading period. A lot of people already looking ahead to Labor Day weekend. The question I have for you is, what do things look like come September?
Yeah, thanks for having me back, guys. I mean, let's be honest. We were up 5 months in a row on the S&P 500. In the troublesome month of August, historically, when you're up at least 17.5% for the year going into August, the S&P's only been higher 3 out of 11 times with some pretty big drops. So I guess the key thing is some type of downside action made sense this August. We've been bullish, but we've been talking about that. And then you talk about September, and we're going to hear a lot about this. But September is usually not that great of a month either historically. So we're still in that kind of troublesome time period. I just want to say this, though. We don't think we're in for some massive, big time pullback. I mean, 6 to 8% might be about as much as we get, down around 4,300. There's some areas of potential strong support. But just with all the bullishness that we saw this time a month ago, a lot of Johnny-come-lately bears flipping the script, it just made sense that, hey, maybe we're going to frustrate some people here and let the market catch its breath.
So, Ryan, do you think September, it sounds like it's going to be pretty similar to what we've seen historically speaking, talking about that weakness? You don't think we're going to see anything different just given the fact as to how weak August has been relative to the rest of the year?
No, that's right. I mean, again, what are we down 4 or 5% or so in August? I guess we're bouncing a little today. But, a little bit more weakness makes sense in September. I mean, I'll be honest, we can get into some of these things. But when you're up over 10% for the year going into the normally troublesome month of September, it doesn't do as poorly. In fact, it's up on average. But again, I think it just makes sense that we still consolidate here, not the end of the world. It's just kind of where we should be focused. And what encourages us, though, is you look at, yes, we've had this 5% approximately pullback in the S&P, more in I get it, more in technology, some other areas. We're starting to see some skepticism coming in, everybody. We've got more more bears than bulls in the AAII poll for the first time in 12 weeks. There's a survey of active managers, the least bullish they've been all year. Put to call ratios, the highest they've been all year. There's just some positive factors to say, listen, we're not going to slip, slide, and just crash in September. Not saying that at all. But again, maybe we're getting close to a low, but just some choppy seasonal frustration is normal.
I mean, having said that, you could argue that a little bit of a pullback, especially around some of these AI names, pretty healthy when you consider the incredible run-up that we have seen, at least in the first half of the year. I mean, what's the sort of range that you think investors should be looking at, and what do you think is going to be driving the market?
Yeah, great point there. I mean, again, tech, communications, AI, those names have had incredible runs. You look at just today, right? What are we seeing? We're seeing some small caps leadership. We're seeing cyclicals. We're seeing materials. Those are some of the areas we think as that baton gets passed around. Energy also, right? Energy is a very small percent of the overall S&P 500. Energy stocks would go straight up for a long time. It might not matter to the market, but to someone who has some exposure, clearly that matters. And again, when you look at the S&P, like I said, around 4,300, that was the peak last August or so. So that makes sense. And it's close to the June lows also. So that makes sense, probably the bottom of the range. And, up around 4,500 or so makes sense. So we just kind of maybe chop around here. The good news, and there's always got to be some good news, right? We don't see any reason not to think that this fourth quarter won't be strong. Historically, fourth quarters of a midterm year are strong, especially after a good start to a year. What's going to drive us? You just mentioned, I mean, we think it's the economy. We don't see a recession. We've said all year there's no recession coming. I love earnings, right? Who doesn't love earnings? I mean, earnings estimates are up over 2% from the start of this quarter. I mean, what's that tell us? Well, maybe corporate America didn't have great things to say about the past quarter, but it's the future that the market cares about. And that is what's going to help drive, we think, eventually, once we get through the seasonal period, pretty strong fourth quarter, probably to new highs on stocks before all is said and done.
So, Ryan, where does that leave tech? Because that certainly has been debated given the outperformance that we've seen since the start of the year. We didn't really see necessarily a lot of excitement, or maybe as much excitement as we had anticipated following NVIDIA's blowout earnings report. Is that still too much of an overcrowded trade in your eyes?
Yeah, we think it is. We're more neutral tech, is kind of where we are with things. And that's a great point, because 3 months ago, NVIDIA had great things to say, and we all know what happened, right? The stock went up, the market went straight up for a couple months, it felt like. Then the other day, up 8% and eventually finishes flat on the day. So again, maybe that's just a sign that tech in general, AI is a little bit tired. Nothing wrong with that. I think as of Friday, tech's still up 35% for the year. It's kind of the way these things work. The lifeblood of a bull market is passing that baton back and forth. And as we've said since our mid-year outlook about 7 or 8 weeks ago now, we think that passing from tech communications to the cyclical value names, small cap names, those areas that maybe when they go up the market doesn't notice as much because it's so tech heavy and comms heavy. But there are some still really nice opportunities for investors here. I mean, what might be a flattened market, but some of these cyclical areas we think can do pretty well here under the surface.
Ryan, I'm looking at Treasury yields today, all pulling back across the board here. It felt like on Friday, the Fed chair speaking at Jackson Hole, kind of sort of towed the line right down the middle to keep his options open, sort of worked for the market. But we're going to be getting two key pieces of data before that FOMC meeting in September, the PCE report, as well as the jobs report. What are your expectations?
Yeah, when it comes to inflation, I mean, a lot of people have talked about this. I'm going to talk about it again. Shelter makes up 41% of core CPI. We are seeing some big time disinflation improvement as it pertains to shelter the last couple of months. That's going to put a lid on inflation. Maybe there's some parts of energy prices, some things are going to come back on the inflationary front, but a big core part of inflation is shelter, and that's going to keep going lower. We think the Fed is done hiking. I want to be clear there. We think the Fed is done hiking. They don't need to hike anymore. I know what they said last week, hit it right down the middle, but we think they're likely done hiking as inflation keeps coming back. And then you get to jobs, right? The monthly employment number on Friday. I mean, as long as we create 100,000 jobs a month, our economy can continue to grow. So that's going to continue to slow. The Fed wants to see the employment backdrop slow. I think we've made almost 3 million jobs this year on the heels of 5 million last year. That's not normal. We want that to slow down a little bit, but we still see growth. And again, the inflation backdrop coming down, the Fed can take its, I don't know if take its foot off the pedal is the right way to put it, but the Fed can at least pause here, take a look around and be comfortable that, hey, inflation's coming back and the economy still hanging in there.
Ryan, what happens though if the Fed isn't done hiking, and you were saying that you weren't expecting any sort of major market correction? If we do see higher rates before the end of the year, does that change your prediction at all?
Yeah, I mean, that can potentially upset the apple cart a little bit. Now, am I still overweight in equities? Yes. I mean, so clearly if we get some stubbornness, and honestly, a potential policy mistake is always a worry there. But, we'll cross that bridge when we get there. I know the expectations for a Fed hike went up just a little bit on Friday as everyone kind of deciphered what exactly it was that was said out in Jackson Hole there. But, we're pretty optimistic that inflation will keep coming back. And obviously, I guess we'll know more on Thursday, right? That PCE number comes out on Thursday. That's obviously a big one. They tell us it's the Fed's favorite measure of inflation. So we're gonna watch it closely.
We will be watching that very closely. All right, Ryan Dietrich, always great to have you. Thanks so much.
Thank you.
Turning to some individual movers on the move today, we've got shares of Chinese stocks, Alibaba, JD.com, and Baidu, all moving to the upside after the Chinese government saying that it is going to lower a trading tax. On this move being done in an effort to hopefully, or at least in their eyes, boost investor sentiment. And Akiko, this coming, as we've talked about time and time again, China's economy certainly struggling there. We've seen investor sentiment obviously take a huge hit as a result of this. So Chinese officials making this move, it's the first time that they've lowered this tax since 2008. How big of a difference this is going to make, of course, is what's up for debate right now.
Yeah, since 2008, of course, the financial crisis. So that tells you where the Chinese government is right now in their approach in trying to boost capital within the markets. This comes, of course, after we heard from Chinese Securities Regulatory Commission earlier this month, trying to propose this list to boost investor confidence. They came up with a number of changes, proposals, including extending the trading hours. But this really points to trying to get that confidence back up. When you look at where household savings are within the Chinese market, that has gone up 60% since the pandemic. And it's worth noting because that points to sort of investors holding on to their cash, sort of the traditional routes of real estate. Certainly hasn't turned out well. And there's concerns there about whether, in fact, they can put that towards the market and really boost capital there. So we'll be watching very closely to see how effective this is. Shares of Hawaiian Electric are soaring as the utility company pushes back against a lawsuit filed by Maui County, blaming the company for the recent wildfires. Hawaiian Electric releasing a statement saying the first fire was caused by fallen power lines, but that at the time of the second fire, electricity to power lines had been cut off. Because of that, the cause of that fire has not yet been determined. Worth noting, of course, we're talking about a fire that killed more than 100 people. There are dozens of others that are still missing. But Shauna, really, that second fire is what Hawaii Electric is talking about that they think is key here. Their statement actually points to the fact that the power lines, according to Hawaii Electric, had been de-energized or cut off for more than 6 hours at the point that that second catastrophic fire was sparked. So they're essentially saying Maui County was careless in pushing this lawsuit. But an interesting discussion that's been playing out that's sort of reminiscent of what we saw play out between PG&E and Paradise when that fire played out many years ago.
Yeah, and there have been a lot of parallels, a lot of comparisons at least drawn between those two situations over the last several weeks. When you take into account what Hawaiian Electric is saying today, Akiko, like you just said, that electricity had been off for hours, at least that is what they are saying. It is important to point out, obviously, that the investigation is still ongoing from state and also federal officials. But Hawaiian Electric, and we're seeing the reaction in shares today, saying that they do not believe that they're responsible for that second fire, which has been the focus. And this announcement coming on the heels of some of the developments that we got last week with S&P downgrading Hawaiian Electric as they were kind of concerned about what exactly the implications would be, the mounting costs associated with this and what that would mean for Hawaiian Electric down the road. So some relief, at least in the share price today, up 46%, but still just above $14 a share. Let's also take a look at shares of BlackBerry trading once again to the upside today up just about 2%. Now, the company reportedly receiving a takeover offer from private equity firm Veritas Capital. Now, according to Reuters, talks are still in the early stages, but it does come after BlackBerry said earlier in the year that it was considering strategic alternatives. That was back in May. So it's very important to point out that it's reportedly that these talks are still in the early stages, like we just said. But we know BlackBerry has been trying to figure out what the path forward looks like for their business. They had left many of these options on the table here, including a possible sale, separation of one or more of its businesses, and certainly been trying to remake itself as a software provider. Hasn't exactly stuck with investors just yet. And I think a lot of people have been figuring out what the future looks like for BlackBerry. And we certainly saw the excitement in shares Friday and also moving once again to the upside today on what maybe this possible deal, if we do see one, what that could mean for BlackBerry going forward.
Yeah, BlackBerry extending the gains that we saw from Friday. But to your point, a lot of viewers probably watch this and think, well, BlackBerry, what have they been doing lately? And of course, we go back to those devices that came pre-iPhone, but they've really been focused on cybersecurity as well as products around Internet of Things, but certainly hasn't been able to gain traction on that, which is why the company has said they're looking at all alternatives here in terms of their portfolio across the board. Well, we are just getting started here on Yahoo Finance Live. Coming up, Trump on trial. The former president's day in court over his alleged efforts to overturn the 2020 election is set. We're going to reveal when you can tune in. And the Biden administration will unveil the first 10 drugs that will be subject to price negotiations with Medicare on Tuesday. Find out if your subscription could be on the list. And later in the show, we'll be joined by a wealth coach who says he achieved financial freedom at the age of 33. We'll get some tips to build your wealth when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
U.S. Commerce Secretary Gina Raimondo is in China this week, meeting with senior Chinese officials in an effort to ease tensions. Now, the two sides reaching an agreement told regular discussions about export restrictions and also intellectual property.
The United States is committed to being transparent about our export control enforcement strategy. Now, I want to be clear, we are not compromising or negotiating in matters of national security, period. But this is meant to be a dialogue where we increase transparency and where we are clear about what we are doing as it relates to export control enforcement. And by the way, to show you how real this is, the first meeting of that new information exchange is tomorrow in Beijing.
Joining us now, we want to bring in Ryan Heath, Axios global tech correspondent. Ryan, it's good to see you here. So we have some of these headlines coming out of China today, opening up lines of communication. We know obviously there's been this tit-for-tat escalation of tensions between the U.S. and China now for quite some time. How encouraged should U.S. chip makers be, should investors be, about the fact that we are likely going to see more communication between the two sides?
Mildly encouraged is probably the best description there. If you are a business that has long-range investments, and that's what all chip making and design is about, then you need certainty. So the more transparency, the more dialogue, the better for you as a chip maker. At the same time, while this isn't precisely true for every different type of chip, we need to be clear that U.S. exports to China are still basically at record levels, and that also includes for some forms of chips. So all of the discussion is around what controls are being put into place, what might not be able to be sold in the future, but the broad environment is still reasonably encouraging. And so it's just worthwhile keeping a bit of that in mind as we work through all of this.
To what extent do you think the Commerce Secretary's visit to China could go far in trying to dial down some of this tension that we have seen escalate from U.S. measures on export controls, China retaliating in some way? I mean, transparency and dialogue are great, but if you're both dialing up the pressure, how much of that temperature can come down?
Yeah. So we're not talking about dialing down the temperature 100 degrees. We're talking, can we dial it down 5 degrees? Can we leave a bit more space for negotiation and discussion in the future? But I do think that sort of mood music is really important. Like, there has been relatively little contact between the administrations for quite a while now. There is tension at the diplomatic level, which is supposed to be the nicest space for discussion. So to have Raimondo there, who is an extremely safe pair of hands, who is extremely well regarded by the White House, who is treated as a serious player by the people she is talking to in Beijing, that's exactly the right person that you want there having these discussions. It doesn't guarantee any outcomes in the future, but it gives you a solid basis for having a more functional relationship, for knowing there is someone who will pick up the phone if there's a new problem that we can't anticipate right now. And that ultimately is the point of this sort of diplomacy, is you want people to pick up your call when it's urgent.
So step in the right direction. But Ryan, what are some of these tough decisions that U.S. chip makers are being forced to make today? Because yes, while this is maybe slightly encouraging, like you're saying, there's still so much uncertainty, I should say, given the fact that tensions have remained high for so long. And these chip makers can't exactly wait around to see what the relationship's going to look like in 12 to 18 months.
Yeah, exactly. And we're starting to see other effects in the market as well. It's not just about what you can and can't sell to China. It's other countries placing orders in case they become subject to a future export control. They also want to make sure, so for example, if you're in the Middle East and you've got a ton of cash that you can splash out on NVIDIA chips, why not stockpile them and then sell them later to the Chinese? That's creating all sorts of ripple effects in these markets. And those begin with what production lines are you going to run in the US at your new chip factories, or what ones are you going to build using all of this new CHIPS Act money that is coming down the pipeline in 23 and 24, through to those global effects, and in the sense of which markets are actually going to remain functional export markets into the future. And then, you know, further on down the line, if sanctions are coming into place, then you've got to think about whether you get implicated in sanctions, depending on how you have set up your contracting. So there are 3-4 layers of effects here that all of these companies are having to think through at the moment.
Ryan, on that first point you made about stockpiling, I mean, that's certainly something that a lot of countries that aren't necessarily manufacturing chips within their home, you know, home borders, certainly thinking about. But what kind of impact has that had on supply in the market?
Yeah, well, it's great if you're a chip maker, because it means the stuff is being sold before you even make it. And it drives confidence in your stock. It makes it easier for you to predict what your future earnings are going to be. So that's great. But it's an absolute nightmare if you're trying to lock down those supplies and the United Arab Emirates or the Saudis beat you to it because they have a bigger pile of cash at hand. So everyone is having to think in longer term horizons. And that's really tricky because we don't know, none of us know exactly where this generative AI revolution is going to go. There's a lot of people out there who pitch themselves as AI experts, and very few people know where this is going. So you can make some educated guesses and some big expensive bets on what you want to stockpile, but that's not entirely clear that it's going to work out, because things can change very quickly with a set of technologies that is this transformative and which is progressing this rapidly.
And certainly we've already started to see that. All right, Ryan Heath, great to have you. Axios global tech correspondent. Thanks.
Well, a date has now been set for former President Donald Trump's federal election case. That's March 4th. And it's right smack in the middle of the 2024 presidential primary race, the day before Super Tuesday. Yahoo Finance senior columnist Rick Newman is here with more. And Rick, the obvious question is, what kind of impact is this going to have on the race?
Well, it has to have some impact on Trump's ability to campaign. We know that he's already diverting a lot of the money he fundraises through all these different charges, and now the mugshot. Some of that money that is going to one of the political action committees, a lot of that is being used to pay for lawyers. That means less available to run campaign ads and things like that. There's also just the simple question of time. How can Trump actually campaign, go to rallies, meet with strategists, meet with fundraisers and donors, do all the kind of things that make a political campaign a 100-hour-a-week job, while he's also in the midst of these trials? And it's even thicker than that, because he now has 3 trials scheduled for next spring. There's the one you just mentioned. That is the one relating to January 6th. That's in Washington, D.C. The very first set of criminal charges, which we all seem to have forgotten about, that's in coming out of the Manhattan District Attorney. That trial is also scheduled for March of next year. And then in May of next year, the other federal trial in the so-called documents case is supposed to get started in Florida. So that's 3 criminal trials for Trump that are now scheduled in the space of 3 months, along with the presidential campaign. Now, some of those trials are probably going to get moved, and Trump can appeal. In fact, I think he has said he will appeal the date of this trial that just got scheduled today. But Trump is just going to have an extraordinary time in 2024.
Rick, how do you see this, or do you see this affecting voter support at all, especially within the primaries? Because there was a new poll out from Emerson College today showing that Trump did see a slight decrease in support, but he still has a commanding lead with 50% of the support within the Republican Party.
I scratch my head along with many other, political analysts who look at these polls and say, don't Republican voters care that Trump could be convicted of a crime by the time they get around to their nomination process, which will formally happen next July. As we all know, Trump has apparently become more popular, not less, amid all these criminal charges in four different criminal trials. People just, agree with him that he's being railroaded. But think about the fact that if just one of these trials actually gets through to completion by the time Republicans officially choose their nominee in July of next year, Trump may be a convicted felon. So is it going to be any different if Republicans are saying, well, now he's actually been convicted by a jury in a trial, not just, prosecutors charged, and he can say it's all political. What if he's convicted by a jury? On the other hand, what if a trial is completed and a jury finds him not guilty? That would validate Trump's claim that he's being railroaded. So I think the short answer for today is there are many directions this could go, including perhaps some unforeseen ones. And it's going to be quite a drama in 2024.
Yeah, the former president's still going to be at the center of that GOP race. We'll be watching. Rick Newman, thanks so much.
See you guys.
Well, coming up, Instacart steps into the spotlight as a grocery delivery company files to go public. But is the IPO market really thawing? We're going to break down the challenges in the deal-making space next.
Markets are higher to kick off the week, and the S&P 500 on track for its first back-to-back days of gains this month. But for the mega cap tech names, it has certainly been a tough month, especially post-earnings. Jared Blickery is on the floor of the New York Stock Exchange with a closer look. Jared.
Hey there, I was just looking at the sector action today on the Wi-Fi Interactive. It's almost a mirror opposite of what I've been seeing for the month of August. You can see all green except for utilities in the red right here. But let's take a look at the month to date. Over the last 20 days, we have a number of sectors down more than 4%. That's everything on the bottom row basically, and then energy is the only one in the green, followed by healthcare and industrials. And then you take a look at the Nasdaq, the mega caps, which largely fueled the rally that we had through July. They haven't done much in the month of August. Amazon, Nvidia, and Alphabet each down less than 1%. Alphabet down by 1.5%, but Apple down 8, Meta 9, Tesla 11. I thought it'd be interesting to chart this with the January through July returns on the x-axis. That is right here. So Nvidia is number one, over 200%, and then on the y-axis right here, we have the August return. So Nvidia is about break even. Meta, Tesla, Apple, all of those are down about 8 to 10%. Microsoft down in there too. You can see there aren't really a lot of standouts. Eli Lilly, by the way, all of these represent the 30 biggest companies in the S&P 500 by market cap. So among these, only Eli Lilly really surging in August. That's up over 20%. It did a little bit in January through July. You got a bunch of financial names and healthcare names in here that just really haven't done a lot this year. What we haven't talked about is industrials. Those picked up in June and July, not really represented here because of the way I've dissected the data. But let's take a look at the leaders month to date. We have everything now in the red. Earlier in the day, PSCE, that's small cap oil, that was in the green, but let's take a look at some of the biggest losers here. Those are some of the fringier parts of the market. Here are meme stocks for August. Let's pull up a year to date. You can see just fell off a cliff in the month of August there. That's right at the inflection point of the month change. ARC started stalling in late July, then fell off in August. IPOs suffering. It's a very similar chart. You can take a look at Bitcoin. A little bit, they peaked a little bit earlier in the year and just kind of fell off very slightly over the last 2 months, but the story has been the same. So not a big surprise. We were heading into August sitting on all these huge gains, and now we're digesting those, and I don't think expectations should be that high going into the end of the month, and maybe not for September or October either. I've been showing this chart a little bit too much, but it's based on the seasonality that we see in the third year of the presidential cycle. Might do a whole lot of nothing for a couple months here, guys.
We will see. All right, Jared, thanks so much for breaking that down.
Well, the IPO market faces a key test with Instacart gearing up for its public debut. The company's plans for an initial public offering coming at a time when the IPO landscape is starting to show some signs of life again. But investors are proceeding with caution, with many of 2021's billion-dollar IPOs now worth less than $500 million, according to Crunchbase. Here to set the scene for public market debuts, we have Crunchbase senior data editor Janae Attir. Janae, I'm thinking back to the conversations early on in the pandemic. There was a lot of speculation about Instacart coming to market. This is a company that was last valued at roughly $39 billion in a private funding round. Did this actually kind of work in their favor to wait a while until they were able to scale? Maybe their balance sheet was a little better?
Well, I think definitely for a lot of these high growth tech companies, if you went out in 2021 and then the markets went down precipitously in 2022 as the game changed, that going out in the latter part of 2021 definitely would not have helped you. However, I think we are in this instance where we've had very few IPOs. We've been tracking this from the Crunchbase data set, how many companies have gone public since the beginning of 2022. And those numbers are incredibly low. And so I think the whole market has kind of been on hold. The late stage market has collapsed. Even seed and early stage funding has pulled back in the private markets because there's been so little liquidity in the public markets. And I think what's novel about Instacart, I think it's the most well-branded startup to go public in the last 2 years. So I think there's a lot of expectation sitting on this listing.
Janae, what is the excitement level from your perspective, from who you've been talking to, just about this IPO with Instacart, given the fact that it is a very brand recognizable name? And what, if we do see it be a successful IPO, what that then signals the remaining several months of the year could look like?
Yeah, well, I think what's interesting, is Instacart is one amongst 3 tech companies that are planning to go public in September. So I think there's not just one, but there's a crew of companies who are beginning to test the public markets. And I think what's interesting about that is I think the reason why they're doing it now is many of these companies have had the last 18 months to get their books in shape. The markets are now valuing companies that are profitable. And so each of the companies, ARM is another one. It's not a venture-backed company. It was on the London Stock Exchange. It got bought by SoftBank, but that's the chip designer and maker is planning to go out. We also have Klaviyo, a data and analytics and personalized email company, also with strong revenues planning to go out. But I think what's different about this set of companies, if you compare it to 2021, is that they're all profitable. They're all showing net income, and that's what the market is demanding. And that's what we haven't seen that in the companies that have listed, in the last couple of years.
You take a name like ARM, it feels like everything's sort of primed for a big debut when you consider just the sheer amount of excitement right now around AI. How much do you think investors, or to what extent do you think it's going to be scrutinized at a time when, at least in this recent earnings season, we have seen a number of investors look at the actual profitability of where the AI business is right now?
Yeah. Well, interestingly enough, ARM is a profitable company. I think the challenge that it faces is that its revenue, which were reported for 2023 that ended in March, were not higher than the revenues from a year ago. So I think what investors are looking at is profitability, but also are these growing companies, can they price these companies for growth in future years? And so I think the challenge with ARM is it's a very large business. It obviously benefits from the focus on chip, on chip designers and makers, but we haven't seen that sort of follow through into its revenues as a company in the last fiscal year. So we'll see where that goes. I think the interesting thing about Instacart, again, also a profitable company, its revenues are up, but its order volume isn't. So is that a growing company? So I think one of the challenges these companies will face is, yes, they're hitting the profitability mark. Are they also growing companies? And that's what the market is looking for.
Sinead, we're starting to see some thawing, at least it sounds like at this point in the tech space when it comes to IPOs. Do you see that moving beyond tech? And where do you expect to see that activity in other industries?
Yeah, I think what everyone's talking about, the analysts that I've spoken to have all said they expect or would like to see this open up in 2024, and they're predicting around Q2. I think the interesting thing just in looking at the 2020 and 2021 IPOs is really where is the market going to value these companies? And so what I'm fascinated by, each of these companies are going out in September. What is the market going to value them at as they go out? How are they going to do as they go out? And it's not really just about these three companies, because all of these investors, invested massively in 2021. The amount of money which went into private companies doubled that year. And just as all that money went in, the public markets cut back. And so I think investors are focused on these three companies, not just because of these three companies. There is a whole host of companies sitting on our unicorn board, high revenue companies who've spent the last 18 months getting their books in order. And is there a situation now where they can debut, where the markets will look at them favorably? We're not going to see valuations that we had in 2021. Those days are over. But will we see valuations that still hold up and give liquidity to investors? And I think, so this is really more about the markets going forward than just these three companies. There's a lot riding on this.
Yeah, Jenna, it's interesting. On the one hand, you're talking about investors, doing a bit more of their due diligence now in the IPO market, just given where things have been. But, I'm looking at a name like VinFast. I mean, yes, they came to market through a SPAC, but just the run-up that we have seen in just a short amount of time for an EV company that has very few cars that are selling here and very few stocks that are trading, it seems to point to the fact that there is still sort of behavior that's just based on a potential and exuberance, not necessarily a balance sheet.
Yeah, I think, there often is, when a company comes out, some exuberance or some excitement around the stock. And really what you have to look at is 3 to 6 months out. How is that stock holding up? And we've seen I looked at the 2021 listing class, 10% of those companies have are at or above, close to just 10% down from where they went public. 90% are way below. So the market is looking at these companies very differently. So sure, as you come out, there might be some exuberance and excitement about potential growth. But the more interesting thing to look at is 3 to 6 months out. How is the market valuing these companies? I do have to say, when I do look at a lot of the companies, even though they're down from their IPO price, when you look year to date this year, they're not at rock bottom. But some of those companies that are in play that have strengths have seen some increase in their stock this year. And so I think that's another reason why Klaviyo and ARM and Instacart are looking to test the markets, because we're not at rock bottom. We have seen some of those stocks. If you've invested this year, you'll have done in some of those companies, you'll have done well so far.
Crunchbase Senior Data Editor, Janae Tier. It's good to talk to you today. Appreciate the time.
Thank you very much. Great to be here.
Coming up, the Biden administration working to make some of the most expensive medicines on the market a lot cheaper. Find out if your prescription could be on the list when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The Biden administration is set to announce the first group of prescription drugs subject to price negotiations with Medicare. But drug makers are pushing back and they're challenging that effort. Here to break it all down is Yahoo Finance's Anjali Kamlani. Anj.
That's right, Shauna. It's an understatement to say that all eyes are on CMS, that's the Centers for Medicare and Medicaid Disease Services. Tomorrow morning, they're set to announce those first 10 drugs, and everybody is waiting to see just who comes under the gun. We already know that a number of lawsuits have been filed, including from Merck, Johnson & Johnson, as well as a number of other companies, including Bristol Myers Squibb. And all of these companies have either suspected that they might be on the list or have, of course, an issue with the negotiation process. Now, who might be on there? Of course, we don't know for certain, but a number of analysts have already tried to decode, and we have a guesstimate of a list of a number of them, including Eliquis, which is Pfizer and Bristol Myers Squibb, and Imbruvica from Johnson & Johnson and AbbVie. There's also Xarelto from Johnson & Johnson and Bayer, and not surprisingly, Keytruda from Merck, and Ozempic was one that recently popped up as potentially on the list. That's, of course, that diabetes drug that's being used for weight loss from Novo Nordisk. So a lot of interesting ones on the potential list, and we'll of course wait to see what the administration unveils tomorrow. This is part of the Biden administration's push to help lower drug costs. And after this point, once that list is out there, the administration basically has 1 year about to negotiate those prices. And then next September will give us that full list of negotiated prices to go into effect for the plan year of 2026. These are Part D Medicare drugs, so it only affects those members in that group so far. But of course, there have been suspicions and some experts saying that this could have some trickle-down effect to the commercial market as well. Again, all eyes on what the administration unveils tomorrow morning.
We will be watching for that. All right, Anj, thanks.
Well, car makers are facing mounting pressure from labor unions. Hyundai among the companies being targeted by union workers. The car maker facing a pressure campaign targeting its EV plants and clean energy suppliers in Georgia. Meanwhile, the United Auto Workers also negotiating with GM, Ford, and Stellantis over the EV transition. Here to discuss the rising pressures for car makers, we have Autolist Editor-in-Chief David Underkoffler, along with Seth Harris, Senior Fellow at the Burns Center for Social Change. David, let's start with you about where things stand in these negotiations with the UAW. What are you hearing about how this is all likely to shake down? Who holds the leverage right now?
Well, I would say that it's certainly the UAW. The wind is at their backs right now. You've got a number of factors that contribute to that. You have UPS. There was just a pretty significant win on the part of UPS with 300,000 workers that represented. And there's one particular item that they won in their negotiations with the company, and that was reducing different tiers of workers. And I know that's a main sticking point right now. With the UAW, that was a main concession they gave to the automakers. I think it was back in the recession when several of them were facing bankruptcy. So there's a lot of, and then there's just sort of a general, wind at the back with UAW with regards to other wins that they've had with other companies they negotiate with. There were significant wins with Caterpillar, John Deere, and Case all in the past 12 to 18 months. So I think they're feeling pretty confident right now.
Seth, as David pointed out there, on the one hand, this is just the latest negotiation labor unions are having in a summer of labor discussions. But at the same time, there's a broader discussion that's happening here about an industry under transition as we go into all electric. Where is the role of labor unions in that?
Well, those are the workers that are going to build these cars. And President Biden has made very clear that he wants the jobs that are created by the massive climate investments in the Inflation Reduction Act to result in good union jobs. And so he's eager to have the UAW organize the plants that are going to make electric vehicle batteries, as well as the assembly plants that are very likely to be UAW plants. But he wants that to happen throughout the clean energy sector. He wants it to happen with offshore wind, and it is happening there in large respects. In solar, in hydro, in other areas as well. So a priority for the president is to make sure that the jobs that are created pay not just a living wage, but a good quality middle-class wage, come with benefits, and come with union representation.
Seth, you mentioned, these are the workers that are building these EVs, but we're talking about a market that is unionized. We have seen many other car makers. We just mentioned Hyundai in Georgia. A lot of car makers that have gone to South Carolina specifically because it's not a union market. how much power you think labor unions still hold, especially in such a shifting industry. A lot of car makers have decided to move out of union markets.
Well, a lot of foreign manufacturers have sought to move into right-to-work states, largely in the old Confederacy, in order to avoid union organizing. But there is organizing that's going to occur in a lot of those places. You mentioned the pressure campaign on Hyundai to ensure that they're either entering into community benefit agreements or that they are entering into union agreements with their workers who hopefully end up getting organized. The big three are different. The big three are represented by the UAW, and the UAW, as David said, and I agree with him, has a tremendous amount of influence, a tremendous amount of power in dealing with the big three automakers. And many of the foreign automakers who do business in the United States are very, very heavily unionized in their home countries. Volkswagen is a good example of that. They are overwhelmingly union all over the world. In the United States, they are not. So I think there will be pressure on all of these companies, particularly using the leverage of the electric vehicle credits in the Inflation Reduction Act, to push them to provide good quality union jobs to their workers.
David, the Department of Energy has recently put out some numbers about the number of jobs that have been created in the EV sector, clean energy sector overall, but in the EV space, it is the fastest growing in terms of jobs. More than 38,000 jobs added last year. I may be putting you on the spot here, but how big of a difference is it when you talk about pay between a union job and a non-union job in a comparable position?
That's where the strength of the UAW really can sort of flex their might. It's pretty significant. EVs are much simpler to manufacture by several orders of magnitude. So you imagine this is sort of, the UAW is facing maybe not an existential threat, but they're definitely looking at the future of their members and saying, look, if these EVs are much simpler to manufacture, they require fewer people to do that, less time to do so. We want to ensure that our workers are protected, not just for the duration of this upcoming contract, which is about 4 years, but longer term. We sort of want to set the stage of, that the UAW certainly has a place at this table moving, into the next 20 years that these EVs are built.
And David, is the expectation that the same number of jobs will be available on the other side?
That's going to be a main sticking point. The UAW is fighting for that. They're asking automakers, maybe who are closing a union plant, in the Northeast, and then opening up for potentially a battery plant elsewhere in the country, like Seth was saying, in a right-to-work area. They're asking that there's a union consideration, or certainly there's been some noise recently with a battery plant in Ohio, where the UAW, they've voted to join the UAW, but they haven't yet ratified a contract, and that's a battery plant. So UAW is certainly looking for all the opportunities that, as old school manufacturing of ICE closes down or shifts, that they have a seat at the table, regardless of where those plants are opened.
Seth, the president has made job growth within this sector, within the IRA, or under the IRA, I should say, really a central theme as he sort of touts his economic accomplishments. But I'm thinking back to a year ago when the IRA was passed, where he talked about not just good paying jobs within a new industry, but also helping workers transition into these new skills. You think the White House has done enough to help workers who have been in these more legacy businesses transition into this new economy, particularly union workers?
The critical issue in that transition is, as David said, going to be wages. Can workers earn the same quality wages in an electric vehicle battery plant that they were earning when they were helping to build internal combustion engine vehicles? And in that plant that David mentioned called Ultium Cells, the UAW has already cut a deal with management, even before they get a full collective bargaining agreement, to immediately raise wages for the workers in that battery plant. That's what I expect to see happening throughout the industry. The transition, the skills transition, I think is not going to be especially difficult. These are very highly skilled workers with a lot of experience with automotive manufacturing. I think that teaching them how to make lithium batteries is not going to be all that challenging. So I don't think that's going to be a problem. The question is going to be, will they want to transition into those jobs because they are high-paying jobs with good quality benefits and where they have a union in the workplace to defend their interests?
Okay, we'll see when the verdict comes out September 14th on the calendar there in terms of the UAW negotiation. Seth Harris and David Underkoffer, good to talk to both of you. Really appreciate the time.
Thanks, Akiko.
Thank you.
Well, coming up, the closing bell on Wall Street, we're going to check in on the latest market moves and the top trending tickers. Stay tuned.
And that's the closing bell on Wall Street. All three of the major averages ending the trading day this Monday in the green. The Dow closing up just over 200 points. S&P up about 0.6%. The Nasdaq, the outperformer of the three, closing up about 0.8%. The moves to the upside coming as investors await readings on inflation and also jobs that we're going to get later this week. Taking a look at the sector action, communication services, the outperformer in today's action, closing up just about 1%, followed closely by real estate, technology, materials, and industrials. All right, let's take a look at some of the trending tickers of the day. First up, XPeng, the stock closing up just about 5%. Now, the company announcing a $744 million deal with Didi, and the Chinese car maker is now going to work on an electric car for launch next year. That's a partnership here with the Didi, and that's going to give, obviously, you would think XPeng a little bit more exposure. This is going to be cars, Akiko, targeting the mass market. Maybe the thought here is also it could potentially help some of those investor concerns that we know it is a very, very competitive EV landscape within China right now. Obviously, lots of competition, but XPeng reaching this deal with Didi, maybe it'll give them a leg up, maybe a bit of an edge against some of their competitors within the space.
Yeah, I mean, it really points to just how hyper competitive that market is becoming over in China. You talk about this new launch or new mass market vehicle. They're looking at launching a roughly 20,500 or 20,600, I should say, is the price tag. So at a lower price point as they look at where the market is right now. Remember, XPeng also took some investments in from Volkswagen, took a 5% stake in the company as well. To me, the interesting part is the partnership on the other side, which is Didi. As you know, this ride-hailing company was at one point trying to develop their own robo-taxis and EVs, but as we know, since the IPO, things have been very bumpy for this company. So we'll see how this all fares. But XPeng getting a lift on the back of that. Well, sticking with the electric vehicle market, VinFast shares riding higher. And now the company has a bigger market cap than, yes, Ford, General Motors, and Stellantis combined. Shana, combined. And remember, we were talking about this company, a Vietnamese company that is really boldly trying to compete in the U.S. market at a lower price point. I mean, I guess there is an argument to be made that because of the limited number of shares that are trading, things have been a little choppier, a little more exaggerated in terms of the moves. But it has been an incredible run in a very short amount of time. I don't know. It's hard to say where this is all going to go, because we have seen what has happened in the past, at least, with some of these SPACs, these upstart EVs that have come to market through SPAC.
Yeah, Kiko, we also have to keep in mind, this is a money-losing EV startup, right? There certainly is a lot of excitement. I think you're exactly right to point out the fact that it's a very, very, very small amount of shares that are available right now. So that leaves this stock prone to wild swings, to volatility. We certainly have seen that play out since it did go public earlier this month. But when you take into account the valuation here, $200 billion, like you said, more than many of the large automakers combined, certainly looks a bit out of step with the fundamentals. And you take a look at this business, it certainly has attracted retail investor attention. I was looking today, it's one of the most watched names on StockTwits. So it really points maybe to some of the volatility and the wild swings that we have seen within the space, and that maybe no surprise that is then attracting some interest from retail traders. But the fact that this is now at the third largest automaker in the world behind Toyota and Tesla, it's pretty incredible. I don't think many people would have expected that when it went public.
No, Shauna, by the way, it's worth noting, in terms of numbers of VinFast EVs, just 137 registered cars in the U.S. Obviously, they're going for scale in the U.S., but I mean, for a car company that is valued at what it is, pretty incredible.
Yes, certainly incredible. We'll see. Likely a lot of volatility ahead, you would think, in that name. All right, well, we are also watching shares of Hostess Brands, the stock jumping on a report that the company is considering putting itself up for sale. Reuters saying that it's fielding takeover interest, and among those interested, General Mills, Mondelez International, PepsiCo, and Hershey. We're looking at gains of just about 2%, and also some analysts, Akiko, weighing in today. Evercore's David Palmer saying that on a possible deal, maybe it would be attractive for some of the other players that we just mentioned there. They have a sustainable, profitable growth, relatively attractive sweet baked goods category. So this could be an attractive target for some of the larger names within this space. And we know Hostess Brands has been struggling with its business now for over a decade.
I know we're talking about sort of the business side of things for Hostess, but I mean, you know, Shauna, I was thinking about the story. I can't remember the last time I had a Twinkie.
No.
And I have been told by those like Brooke De Palma that the quality is much, much better now. But I don't know. I have not tried one in years. So
I was going to say, I'm going to take your word for that. I don't know if I'm buying it, though.
Yeah, I mean, obviously, you know, Twinkie or Hostess, I should say, looking for other buyers in the market. We're going to be watching that space really closely. It'll be interesting to see how this all shakes down. Well, this week, Yahoo Finance is taking a closer look at the Magnificent Seven and what investors should keep in mind with the biggest names in tech. Today, we're kicking it off with NVIDIA. The stock has been on a tear this year, riding the AI wave like no other company. But how high can NVIDIA go? Here with the details is our very own Ali Garfinkel. Ali, tell me you have an answer. How high can it go?
I sort of have an answer here, Akiko, because NVIDIA has climbed so substantially, right? 225% up year to date. It's $1 trillion company. But there is this central question, which is how long can it keep growing like this? And the answer is that it can't. The train is going to have to slow down. And there are a lot of experts that I've been talking to saying that most of the growth that we could see out of NVIDIA is already priced into the stock. So there are two things here I would say we need to consider when thinking about NVIDIA long term. The first is competition. There will be more competition for NVIDIA eventually, and we could even be closer to that than we thought. We're especially going to start seeing it when it comes to cheaper alternatives to what NVIDIA is offering. We're starting to see alternatives like that come out of AMD a little bit. The other thing to consider is customers designing their own chips. That is going to be a certain kind of competition for NVIDIA. Consider Apple, which already does this. Amazon also has its own burgeoning business through AWS designing its own chips. So competition is going to start emerging from all sides. Now, the other thing to consider, and this isn't something that's talked about really consistently, but NVIDIA fundamentally is a cyclical business, right? This is a business that has been able to capitalize on trends over and over again. Remember, they were also in a lot of ways a company very much tied to crypto. It was actually the company's GPUs that were most consistently used in crypto mining, for example. I think they're also really susceptible to the vicissitudes of the AI hype cycle itself. Customers are, flying in, purchasing these chips at huge rates, and they are expecting to see some returns. If those returns don't really translate into new business, for example, those expectations could fundamentally also falter.
Ali, do you think the hype is warranted given the fact that it has such a large lead amongst when you compare it to some of its competitors, or is maybe some of that hype, I guess, overhyped at this point?
It's hard to say, Shauna, but there's something really interesting, and it's going to sound like I'm splitting hairs here, but it's an important distinction. We might be expecting too much from NVIDIA over time, but no one I spoke to would say it was overhyped. And the reality is this. Here's why. When it comes to AI processing, they are really still the only bar in town. They are offering a really full ecosystem for all kinds of enterprises. And one of the key ones is going to be the public cloud. They offer a full stack for the public cloud that just doesn't exist anywhere else. Competition also might be coming down the pike here, but it is far from mature. So it's going to take a moment for supply and demand to really come into balance. But I think it's worth saying the NVIDIA hype does have its bearings in real technology. That said, they do have a problem here, right? NVIDIA has a problem. What do you do for an encore, right? They came in with this incredible earnings cycle. My experts are saying the next 2 to 3 quarters could also be pretty good, maybe not quite as good. But don't expect this raucous party to last forever because there is simply no way. What goes up must come down.
And no question, their competitors are looking at that, eyeing a piece of that market share as well. Ali Garfinkel, thanks so much for that. Well, coming up, do you want to quit your 9-to-5 job and become financially free? Our next guest did that himself and has some tips to help you achieve that goal. That is coming up on the other side of the break. We'll be right back.
outlet centers are value shopping experiences for people that are looking to buy brands at the best possible price. And in this environment right now, that's what the customer is looking for.
Really the big issue here, two big issues. One, private companies in the sector, smaller companies, mid-sized businesses are being much more squeezed than their public counterparties. And the leverage position of companies is going to be the big story over the next 6 months, but really the next probably 24.
Spending is down, and that's going to put back to school shopping at risk, and back to school shopping is a bellwether of what's ahead for Christmas and holiday shopping.
We've seen a significant uptick in organized retail crime, and it's certainly impacting the profits of organizations. So we need to educate folks on what organized retail crime actually is. And these are individuals and groups going into stores, stealing massive amounts of quantities of merchandise in various stores day in and day out.
These smash and grabs, or they've been called mobberies, are very lucrative and very successful for them. And so until there are things put in place to mitigate damage or to resist this current surge, there's going to be an increase in these type of activities.
It's those retailers that are careful with their money in the years leading up to whatever downturn you're looking at, are the ones that have a better chance of turning things around.
The consumer continues to be concerned about inflation. Promotions, pricing, and so forth are certainly top of mind. There's a price sensitivity on the part of consumers, but they continue to spend.
Comparing Walmart to Target directly is something of a false equivalency. They're very, very different businesses. And in an environment where consumers are stretched and just trying to cover the essentials, Walmart, who is the biggest grocer in the world, is going to benefit tremendously from that disproportionate focus.
I'm in agreement. Trend that we've been seeing a lot with Walmart is that membership number. Not only have they been gaining new customers, but they've been able to keep the existing customers. And that in return is turning into loyal to consumers that are now extending themselves.
The consumer this year has been much more cautious, looking for deals, looking to trade down, looking to buy lower priced items within category, and to buy smaller baskets.
2022 and the early part of 23 were challenging across the board. There were only one or two luxury players that weren't hit in North America. But when I look in recent weeks and when I look at the forecast for the rest of the year, I think we have turned a corner.
The future of retail is media, and the future of media is retail. I think as you look to the future, like a year from now, you're going to start seeing that these retailers are driving content shoppable experiences.
Watch this if you want to invest but don't know what to buy as a beginner. Everyone tells you to invest in ETFs, but no one actually teaches you how to look into the details. I'm a 36-year-old self-made millionaire and former public school teacher, and I'll teach you in 60 seconds. These are the 5 bank accounts everyone should have by the time they're 30, and if you don't ever want to go broke. If you're in your 30s or 40s and think it's too late to become wealthy, you're wrong. 5 things all 18-year-olds should do right now. Watch this if you don't know which 401k to open up. And these are the 3 things you need to know in your 50s.
That was 36-year-old wealth coach Steve Chen, who taught in a public school for 7 years before moving forward with a financial coaching business. Steve has more than 1 million followers on TikTok, and he's striving to teach people how to become financially free. And Steve Chen joins us now. Steve, you've got a great story going here. Talk to me about how you made the pivot from a public school math teacher to a social media coach.
Thanks for having me. Yeah, that's a great question. So I taught for more than 7 years. And when I got my first couple of paychecks as a teacher, I was like, oh my gosh, there is no way that I can survive or retire comfortably just by saving my money in a regular savings or checkings account. So I basically just went down this whole rabbit hole and found out that a lot of wealthy people, they were part of this community called the FIRE community, or the financially independent retire early community, where they were able to retire by the age of 40, 50 years old. And I found out that every wealthy person basically invested. So I went down this rabbit hole, learning how to invest. And I was pretty good with my money. I learned everything kind of like by myself online. I was saving very frugally because that's what my parents taught me. in an Asian culture and in my immigrant Asian family. And I was investing little by little just into boring ETFs, index funds. And I was just kind of money hacking here and there, getting some side hustles, tutoring on the side. And by the time I was around 32 years old, 33 years old, I told my friends and family members that I was going to quit my job and kind of share with the entire world about how to build wealth and how to become better with money, because I really believe that it's very attainable for everyone, especially for those of us who never learned about money. I think that once we learn about money, it's really not that scary. So in 2020, I was like, okay, I'm going to quit my job. And that's when COVID hit, which kind of worked out kind of perfectly, to be honest. And I told my parents, and I remember my mom was like, you're going to be on TikTok, YouTube, what is this, right? So I was explaining to them, and I made the transition over. And yeah, we launched on July 2020, and we have more than 1 million followers across all social media platforms now. So it's really exciting. It's been a really crazy journey.
Steve, I think a lot of people look at an influencer like you, a content creator, and think that, hey, I can do it, but they don't really know where to start. So how did you, one, go about building your audience? Because you went about it in a little less traditional type of way. And then the second thing is, how do you get people to trust you? How do you earn that trust? Because I think also a lot of people will be asking themselves why they should be listening to your advice, maybe over a financial analyst or someone who has a little bit more background within the industry.
Yeah, absolutely. It's funny because sometimes when I make my videos, I'm like, oh my gosh, would I even trust myself? I'm like a random person on the internet, right? But my main core message is I don't like this whole get rich quick scheme or like get rich quick route. I tell people, hey, if you want to build wealth, right, we want to do so in a responsible way. We're going to get rich slowly, okay? So it's going to be a lot of the boring, unsexy stuff. We're going to be saving, being more conscious with our money habits. We're going to increase our skills, so this way we can increase our income. And of course, we're going to put away a little bit of money, $50, $100, $200, whatever we comfortably can every month into something like a retirement fund, and just let it compound over time. I think taking these small little habits, even though it might just only make a 1% change, it really does compound over the next several years. And really, that's how we become successful. All successful people are successful because of their positive wealth habits, right? So I would say that before just listening to just one person, even with me, right, I would say, yeah, kind of see if these money tips work for you, and also kind of cross-reference it with other people too, to see how other successful people are also building wealth. And I can tell you, pretty much all the responsible people out there, I know, not the super sexy, like, oh my gosh, you're going to make $1 million this year, just by doing this and investing in this NFT or anything like that. But pretty much all wealthy people that I've met, that I've studied over online, they all have these positive wealth habits. And really, they follow these three things: live frugally below their mean, right? 2, increase their skills, increase their income. And then 3, just steadily, slowly invest on a month-to-month basis. And really, these are the 3 pillars of wealth.
So let's kind of break that apart. I mean, you've already kind of given us a brief lesson. You said there's 3 pointers there. Live frugally. What does that mean?
Sure. Yeah. So for me, when I was in college in my early 20s, I saw a couple of friends. They went out to eat every day. They went out to a whole bunch of bars and clubs, which is totally okay once in a while. And I saw a lot of people like buying flashy clothes, flashy cars. I had a friend who bought a BMW, which was, I think, $50,000 at the time. He used his financial aid money to purchase that, which I kind of like, yeah, it's a pretty funny story. But I think during our 20s, it's a very important time to develop these habits of living below our means, right? By not going out so much, by making sure that the money coming in is way more than the money that's leaving our bank accounts. So some actionable things we can do is maybe meal prepping, right? That's what I did. That's what helped me throughout my 20s. I didn't go out as much. Of course, once in a while, I would go out with my girlfriend, who's now my wife. We would go out for a nice dinner, but most of the time I would cook at home, or maybe instead of going out to party, going to these clubs, buying these $15 drinks, I would have board game nights, or I would hike with my friends. So I think building meaningful relationships, having these positive memories with my friends and family members. It doesn't really need to cost a lot of money. It's just really the perspective on how we go about it.
Steve, one of the other pillars that you mentioned there, to invest slowly on a month-to-month basis. How should people be thinking about their future retirement and how much money they should be allocating on that monthly basis?
Yeah, that's a great question. I think it really depends on each individual, of course, and how much they can comfortably invest. But I would say if you are younger, then of course it's going to be less money that you really have to contribute. The older you get, the more money you're going to have to contribute because you don't have that much time. So if you're watching this, you're in your 20s or 30s, you would probably want to make it a goal to invest anywhere around $50, $100 a month, or even to around $541 per month. So the reason why I say 541 is because that's how you max out a Roth IRA, which maybe I'll talk about in a little bit. But if you're able to max out a retirement account like a Roth IRA, around $6,500 a year or $541 a month for the next 30 years into something that is kind of boring, that tracks the S&P 500, the top 500 companies in the United States, Microsoft, Amazon.com, Alphabet, Google. And we do that for the next 30 years and we let our money just compound over time. We can say that we can grow our accounts to around $1 million if we get average annual returns. So for those of you watching, I would say anywhere from $50 to $300, $500 a month. That's typically the sweet spot.
I'm taking note. Takes a lot of discipline for sure. Call to Leap founder and wealth coach Steve Chen. Good to talk to you today. Appreciate the time.
Thank you so much. Thank you.
OpenAI launching ChatGPT for businesses with added features and privacy safeguards. Here with the latest is Yahoo Finance's Dan Halley. So Dan, there's going to be a ChatGPT for business, but are employers, do you think, going to feel comfortable with using ChatGPT at work?
Yeah, part of the original problem with using ChatGPT for work was the idea that, look, some of the data that you input or get in return would then be used for training models. So that could have led to some information from companies, sensitive information, leaking out into the public as a result. And so what OpenAI is doing with this new version of ChatGPT Enterprise is ensuring privacy. So inputs won't be used to train models. There's also the benefit of getting the latest version of GPT, as well as no throttling for question responses. So instead of getting a slowdown, you'll end up getting that without any kind of issues. It's also going to be faster overall than the standard version of GPT. So this is something that will help the company grow as far as overall revenue. Remember, this company was once a nonprofit or not-for-profit, and now it is a regular for-profit company. But it does also mean that it will somewhat be going up against Microsoft, which invested about $10 billion into OpenAI. Microsoft uses, of course, OpenAI's technology in its own kind of generative AI copilots. It's what they call them. They're basically chatbots and apps that you can build on. But they have their own services. They have Microsoft 365 Copilot, things along those lines. So seeing how that lines up with this version of ChatGPT Enterprise could mean friction between the two firms, although it is important to point out that what Microsoft does is highly tailored to its own products. And so that could be the way that the companies are avoiding any kind of dust up or overlap, where, you know, this is just a version of GPT for Enterprise, whereas something like, you know, Microsoft 365 Copilot is specifically built for Microsoft 365. So, you know, there could be some overlap here. I think overall, though, it just means that we're going to continue to see AI proliferate across everybody's work.
Certainly seems like that. And also another step, I guess, in the direction that they want to go in terms of future revenue. All right, Dan Halley, thanks. Well, coming up next, we'll go around the horn with some of the top stories of the day. Allie and Josh, what's on deck, guys?
Well, Shauna, there's two luxury retailers that potentially could be merging. You know them well.
We'll tell you who they are and what it means for the overall retail sector next.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer, Pros Supermanian. We're kicking things off, guys. It's a little fashion news. According to the New York Post, now this is just a report, we could see a big shakeup in the fashion world with Neiman Marcus looking to potentially sell itself to Saks Fifth Avenue. Now, this would be quite the big undertaking. I'm sure there'd be a lot of regulatory hurdles involved with that, considering Neiman has about 38 stores compared to Saks 40 stores. So if you think about the behemoth that could be, it'd be a pretty serious combined company. But Neiman Marcus, they've been going through a lot of challenges, just an overall slowdown, a bunch of layoffs that we've seen hit the retailer, especially after that post-pandemic boom that we saw in luxury goods seems to have slowed down a bit. The Post is saying that the company could receive possibly $2 billion for this. But it just makes you think about the larger retail
company that
space.
was once worth over $5 billion too, right? If you go all the way back to 2005. So the valuation has come down quite a bit. And it's just been interesting to think about the Neiman Marcus story as a whole since the pandemic. They were really the first retailer to file bankruptcy because of COVID, essentially saying the pandemic made it so they could not continue operations at a way that they were. But they filed Chapter 11. They're able to come back. They actually benefit a lot from the luxury resurgence. And now you're seeing it come back down again. And you sort of wonder, like, where's normal, right?
Yeah.
Because 2020 for their defense, too, when they had to file bankruptcy, that wasn't normal, right? And then you get the big resurgence, also not normal. So how do you sort of right-size? Maybe if they were to merge with Saks, you can figure out a way to right-size, and you can maybe combine those stores in some way. I don't know if that's what you wonder what the eventual plan is, right? Would they want to own 80 big retail areas? I don't know, because
they were arch rivals, right? And Neiman Marcus also owns, I should say, Bergdorf Goodman, which is huge in New York City. Like, these are some serious names in the luxury space.
Yeah, I mean, look, Neiman Marcus didn't really have the sort of online presence that Saks did. Like, Saks at least has a good online presence. Neiman Marcus is sort of empty there. And I think combining the two footprints of those two big names will make a nice sort of combination there. I'm not sure, the antitrust stuff, maybe not much of a concern, because when you think about like how much these guys are just not in the online space at all. Like, both of them are just not there online, right? So it is a nice combination of two big storied luxury names. You mentioned that 2005 reorg that Neiman went through, and that was a terrible LBO, leveraged buyout situation. They were on a ton of debt. It almost made sense that once a bad economic sort of hardship kind of hits you, like COVID, they just got knocked out. And Saks is a much better spot with Hudson Bay owning them. I think this better combination, recapitalize. Maybe you pick and choose the right markets for luxury, bigger markets, not mid-tier. Could work for them.
I was going to say, you wonder what happens to some of the real estate, right? Because you would think you don't keep 80 stores between the two of them open. And then you're talking about pretty prime real estate. They don't put Saks Fifth Avenue, prime real estate place, right?
And you don't see
Neiman Marcus and some high-end, when you think about where they are around New York City and around other big cities, that's pretty prime real estate, and it'd be interesting to see if they maybe even take it to just offload some of that. You could use some of it and just sell it, right? And get rid of the real estate that way.
And I also think consolidation is inevitable for some of these bigger department stores, whether you're luxury or not, especially when you talk about the online space and the Amazons of the world really providing some
Yeah, I mean, since all these other big luxury high-end online like retailers, why would you need to go to, Neiman Marcus? But we'll see.
And sticking with potential retail closures or some mergers and interesting things going on in the retail space, I have my eye on Nordstrom. Nordstrom closing their flagship location in San Francisco over the weekend. Interesting to see them sort of backing out of this big mall. Obviously a trend we've seen, some pretty wild images to take a look at on your screen right now. But I think what stuck out to me is that it is in San Francisco. And San Francisco downtown right now, it's not like we're just talking about Nordstrom. There's been an exodus in the San Francisco downtown area, overall from retail, overall from just businesses in office spaces. Crime has been a big problem in San Francisco. And then when you think about the retail story and what we've been talking about with theft, you wonder if that's going to play a role in the overall retail sector here, right? We just have retail earnings the last 2 weeks. Basically everyone, including Nordstrom, talked about theft having a problem. Shrink is having a problem at these stores. If I am a store retail owner and it is that frequent of a problem in different places, when you think about a high crime area like San Francisco, do you just operate less stores in cities where it's a problem? I wonder if that becomes a trend.
It's crazy to me that theft is such an issue.
I mean, those images were like JCPenney back in the day when they were closing, right? And now it's actually Nordstrom, a very successful retailer. San Francisco is, I mean, that story goes beyond what, beyond the scope of what we can talk about here. But, you heard Elon Musk saying, we're not going to leave San Francisco. We're going to stay there. Easy for a business to stay there when you don't really operate a retail operation where people are coming in, strangers off the street coming in. It's not a security risk situation. But San Francisco, just hopefully they can kind of rebound and get the office workers back in the city, get some sort of crime and drug use sort of control there in that city. Because right now, Nordstrom, I mean, that's a pretty big retailer that's going to be gone. And we showed a graphic of like Whole Foods, a couple other retailers are leaving the city.
Right. Like really the number one in their respective industries, right? Just leaving the city.
And it's a trend also beyond San Francisco too. And you just think about retail. UBS had great research when Bed Bath & Beyond filed for bankruptcy about just the fact that this is going to be a thing that you are going to continue to see. Michael Lasser over at UBS estimated 50,000 retail stores are going to close by 2027. 50,000 stores. That is a lot of stores when you think about, we talk a lot about the Amazon effect and what e-commerce has done.
Well, look,
but that feels like more than just Amazon. That's just not being able to get people in some of these stores too. And maybe just some of these stores, I mean, you specifically think about the Bed Bath story, they just expanded too big in areas. They just had too many Bed Bath stores in too close of an area. And so it's interesting to see now how companies are rethinking that strategy. You don't need to flood the zone necessarily with in-store retail.
Yeah, one of the key points that Lasser pointed out was the high operating costs and wages and how much it takes to run a lot of these stores when you have that online presence at the same time. It just feels like there's a lot going
just ship it to them. Just ship them some stuff.
I
think Amazon did that well, right? We don't need to run stores. Let's just send people stuff.
Go to stores and I ship them after I try them on in stores to my parents' place because I avoid the taxes in New York.
Okay.
Smart. It's a smart work.
That's a savvy tip. Only on the round
table. Tip.
So
the more you know.
Beyond right-sizing retail, it's all about where do I ship this stuff?
Yeah, so now I'll do a little bit of both.
Yeah, and it's all part of the e-commerce, kind of wave here, and sticking with that e-commerce wave we're talking about. Our good friends Uber Eats, where I'm a huge sort of proponent.
Big consumer
in the city. I guess a Bloomberg report here talking about how they found, looked in the code of the app, and they found a AI assistant there that Uber's working on that'll basically allow you to sort of give you recommendations based on what you've been ordering, what you want to eat, what you want to kind of have tonight, that sort of thing. So it's an AI chat assistant there. I'm an avid user. We'll see if I use that kind of thing. And also want to touch on a thing with DoorDash. It's a little bit different here. Basically, they're going to offer a situation with restaurant operators. If you call them and they can't pick up your order, they can't talk to you, an AI-powered voice service will pick up, ask what you want, answer the call, maybe get you an order going. I know two different services here, two different things, but both AI-powered.
Ross, what's the number one thing you hate when you call something nowadays? Probably it being answered by a robot, right?
You don't want to do it through the chat hell, voicemail hell.
I don't want to do it on a chatbot, but I do not want a computer to answer the phone.
He sighed when you started talking about this.
Are you kidding? Just don't pick up. I don't want to do it.
What do you want, pizza?
I agree.
Use the app. Just use the app. I like calling every now and then.
However, I will say I've called restaurants several times.
Yeah, they don't pick up. They can't hear the phone. Right.
And that's the point here. They're saying they're leaving money on the table if they don't pick up. They said there will be live agents to help assist if you run into a problem with the robot.
If I was a restaurant, I would tell my employees to get better at picking up the phone and not pay for an AI service.
But if you're crazy busy, then maybe you have to hire more, which obviously...
Maybe you couldn't tell. Maybe you actually use AI is so good you can't even tell when it answers.
That'd be scary.
Pivoting to the Uber thing, I like that. That to me is
I feel like they're already doing that.
Yeah, well, that's what AI is doing on social media too, right? I mean, that's what TikTok does for you automatically the entire time. That's what Instagram Reels has been doing, and Zuckerberg said it's been successful for them. I think it probably leads Uber to honestly make more sales. If they know you're a deal-oriented person and they just feed you deals, then they know what kind of food you like.
If they know on Sundays at 5 p.m. you always are craving a milkshake, they'll
you get the Sunday morning bacon, egg, and cheese every Sunday. They'll feed that.
But I think it's a chat bot, right? So it actually talks to you. What do you want, Josh?
And you're like, hey, you ate a lot of fried food this week.
Power protein shake. You're about to go to work out. Anyway,
he's gonna eat all the healthy stuff, and I'm getting all the Chick-fil-A, and that's the problem. Well, we'll see what we're ordering after the other side of this break. Stay tuned. Yahoo Finance will be right back.
Outlet centers are value shopping experiences for people that are looking to buy brands at the best possible price. And in this environment right now, that's what the customer is looking for.
Really the big issue here, two big issues. One, private companies in the sector, smaller companies, mid-sized businesses are being much more squeezed than their public counterparties, and the leverage position of companies is going to be the big story over the next 6 months, but really the next probably 24.
Spending is down, and that's going to put back to school shopping at risk, and back to school shopping is a bellwether of what's ahead for Christmas and holiday shopping.
We've seen a significant uptick in organized retail crime, and it's certainly impacting the profits of organizations. So we need to educate folks on what organized retail crime actually is. And these are individuals and groups going into stores, stealing massive amounts of quantities of merchandise in various stores day in and day out.
These smash and grabs, or they've been called mobberies, are very lucrative and very successful for them. And so until there are things put in place to mitigate damage or to resist this current surge, there's going to be an increase in these type of activities.
It's those retailers that are careful with their money in the years leading up to whatever downturn you're looking at, are the ones that have a better chance of turning things around.
The consumer continues to be concerned about inflation. Promotions, pricing, and so forth are certainly top of mind. There's a price sensitivity on the part of consumers, but they continue to spend.
Comparing Walmart to Target directly is something of a false equivalency. They're very, very different businesses. And in an environment where consumers are stretched and just trying to cover the essentials, Walmart, who is the biggest grocer in the world, is going to benefit tremendously from that disproportionate focus.
I'm in agreement. Trend that we've been seeing a lot with Walmart is that membership number. Not only have they been gaining new customers, but they've been able to keep the existing customers. And that in return is turning into loyal to consumers that are now extending themselves.
The consumer this year has been much more cautious, looking for deals, looking to trade down, looking to buy lower priced items within category, and to buy smaller baskets.
2022 and the early part of 23 were challenging across the board. There were only one or two luxury players that weren't hit in North America. But when I look in recent weeks and when I look at the forecast for the rest of the year, I think we have turned a corner.
The future of retail is media, and the future of media is retail. I think as you look to the future, like a year from now, you're going to start seeing that these retailers are driving content shoppable experiences.
Fed Chair Jerome Powell says further rate hikes are on the table. Powell adding that the Fed intends to hold rates at a restrictive level until inflation reaches that 2% target. Yahoo Finance was on the ground in Jackson Hole, Wyoming last week when Powell made those comments at the Fed's economic symposium. Our own Jen Schomburger sat down with former Kansas City Fed President Esther George to get her take on Powell's speech. Take a listen.
He met my expectations. I knew this would be a widely anticipated and watched speech. And so I think for him, very important to reinforce messages that he's been giving and that the committee's been giving, which is we remain squarely focused on that 2% target. We see how the economy is performing. And there's some uncertainty here. And so we want to make sure that markets, that the public know we haven't given up on 2% and we'll continue to watch that.
Many have said that he was moderately hawkish. We know that the Fed is data dependent, and Chair Powell emphasized that again today. If you look at the data, it's been quite strong, quite resilient. Do you think that spells a higher rate hike path than what was put forth in June?
Well, I think if you listen to his remarks today, he laid out a couple of options there to say it could mean more rate hikes down the road. It could also be a call for patience. And if you think between now and the September meeting, there will be more data that comes in. I think that's going to inform how this committee thinks about what the next steps were. We've heard today about the uncertainty. People are very pleased, as am I, that the economy looks resilient today. But there are lags to this policy, and a lot has been done that I think this committee wisely is wanting to see how it unfolds.
Chair Powell says he's encouraged on inflation, but there's still a lot of work to do. We're going to get a couple more inflation reports between now and the September policy meeting. Do you think that's going to be enough for the Fed if those reports come out as the last couple have to move into an extended hold, or do you think they would opt to wait till November and collect more data?
Yeah, I mean, if it were me, I think you could wait till November. I think he made the point today, we've had 2 months of data that were encouraging, but it doesn't yet make us convinced that we're on the right path. And I think one of the lessons from past committees is you don't want to declare victory too soon, that you want to keep your eye on that inflation and really have a level of confidence. So I think there could be a number of things. They'll be watching the labor market carefully. They'll be watching those data prints on inflation. They'll be looking at what's happening in the broader economy to try to understand where they might be.
And to your point on the labor market, Powell said if we don't see further easing, that could require a monetary policy response. So obviously inflation has been the number one thing that the Fed and much of the markets have been focused on. But if the labor market remains strong, what do you think that spells for policy action?
Well, the labor market's an important indicator of the health of the economy. It's very tight right now. There's been some softening. I think one of the things in the anecdotes they hear is that businesses are less concerned about some of the very aggressive wage hikes they had to make, which may mean there's better balance coming in between workers' expectations and inflation. But job vacancies have not softened the labor market enough to bring inflation down. So I think these imbalances that have been the theme of this conference are going to be really important to watch. Supply is helping some. The Fed has a job to do with its rate increases. How much more? I think they're being very open to watching the data.
So to your point, you know, getting to the peak on rates is one thing. How long you hold for an extended period of time is another. How long do you think the Fed will remain on hold? Do you think we'll see really a 5 handle on rates for through 2024?
Yeah, I'll be very interested in the SEP or those individual projections that the committee will submit in September. I think even the last set of projections suggested people thought 2024 would allow them to begin to back off of some of those rate increases. So that's why I think the coming data releases are going to be really important to them to gauge, are we holding longer? Really, I think the experience of this past year has been to push out some of the concerns, you know, whether it was worried about recession, or it was worried about, you know, pain in the labor market, that continues to be pushed out. And it could happen again, I think, with this next set of projections.
So we've seen so much resiliency. People are now calling for a soft landing instead of a recession. How much longer do you think we can continue with this? I mean, no one canceled the business cycle, right? So what's it going to take?
So one of the things I think about are the lags. And there's, you know, been a debate about whether they've shortened because of financial markets and communication by the central bank. And that may be the case, but I think there is still more to come. When you think about how aggressive last summer the committee was, they've made additional hikes. That I think you're going to have to wait and see. That can take up to 18 months, which suggests we may be through the end of the year before we begin to see further effects. And that's why I think there's a good case to be patient right now before you make a call on whether more rate hikes are needed.
Switching gears, I always like to ask women in economics this question. Saturday is Women's Equality Day, and there still exists a major pay gap. Women are making 83 cents on the dollar versus men who are in full-time positions. What is your thoughts on how we can close the gap?
Yeah, I think women have to continue to do what they've been doing. They've made progress. I think they are getting more visibility. I think companies are beginning to see the opportunities, ways to include women. We've done that at Jackson Hole in terms of bringing more visibility. So I think those are going to be the kinds of things where skills are in high demand. This is a time of a tight labor market that you would hope to see some of those kinds of gaps closing. But it's an important issue. It's one that's been with us a long time, and no silver bullets on how to address it other than to keep it in front, I think, of the public's attention.
Well, Esther, thank you so much for your insights. Great to see you here at Jackson Hole.
Thank you, Jen. Appreciate it.
That's Esther George, former president of the Kansas City Federal Reserve.
All right, well, coming up, it's closing time here on Yahoo Finance. We'll recap the top stories of the day and get you set with everything you need to know tomorrow. Stay tuned.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement. What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
All right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Tropical storm Idalia is churning its way toward the Gulf Coast. It is expected to gather strength and become a Category 3 hurricane as it approaches Florida. President Biden approving a disaster declaration on Monday. He promised full support of the federal government to Florida in a conversation with Governor Ron DeSantis. Idalia is on track to reach the Florida coast on Wednesday. American Airlines hit with the largest fine ever from the Department of Transportation for keeping passengers on the tarmac. The DOT issued a $4 million fine over the violations, with the agency saying American broke rules on dozens of occasions between 2018 and 2021. The airline will only have to pay half of the fine to the government. It will be getting a credit for the rest of the compensation for compensating the carrier paid to passengers. And Goldman Sachs is unwinding another deal made by CEO David Solomon. The bank is selling its personal financial management unit to Creative Planning, a competitor in the space. The price tag of the deal was not disclosed, but Goldman says it will result in a, quote, gain.
Now here's what to watch tomorrow. We will be getting the latest job openings report from the Labor Department. Economists expect the numbers from July will hold steady around 9.6 million for the third month in a row. It comes ahead of Friday's jobs report, which will give the Fed more insight into the labor market ahead of its meeting next month. Investors will get another read on the consumer with the latest data on consumer confidence. The report follows a mixed earnings season for retailers, with a number calling out a cautious consumer and a slowdown in spending. Now, before the opening bell, we will get earnings from Best Buy, J.M. Smucker, and Big Lots. It's been a tough year for Best Buy. The stock down nearly 8%. Margins have been squeezed amid declining sales and also higher inventory. And after the bell, we will get a closer look at the tech sector. We will be getting earnings from HP Enterprise, and Box. Well, that does it for us today on Yahoo Finance Live. We'll see you right back here again tomorrow afternoon. Have a great night.